Today, the markets are reaching rarefied heights. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 20th of April 2019, our weekly review of the latest property and finance news. And today this is just a short edition, partly because it's Easter and partly because there's just less to talk about today. And before we start, just a quick reminder, if you'd like to support our efforts, you can do so via PayPal. Make a one-off contribution, here is a link, or alternatively contribute via Patreon, where you can subscribe on an ongoing basis and also get access to additional research and information. And again, the links are here and in the comments below. The first thing to talk about today is the latest Reserve Bank minutes, which came out on Tuesday. And they showed that growth had slowed markedly in the second half of 2018 compared with the first half, and GDP had increased by just 0.2% in the December quarter and by 2.3% over the year, which is below the forecast that was presented in the February statement on monetary policy. Growth in consumption has clearly slowed in the second half of 2018, and the weakness has been concentrated in discretionary items, especially those that have historically been most correlated with housing prices and housing turnover, such as motor vehicles and home furnishings. Retail sales data and contacts in the Reserve Bank's liaison programs suggest that growth in housing-related consumption had remained soft in recent months. And conditions in the established housing market had remained weak in recent months, and housing prices had continued to fall in Sydney, Melbourne and Perth, and had declined a little in most other capital cities and regional areas. And in March, they say, Sydney prices were down 13% below their 2017 peak, and Melbourne prices were 10% below their peak. And although auction clearance rates in Sydney and Melbourne had increased over the first quarter of 2019, they remained at relatively low levels. Housing loan approvals were materially below their levels of a year earlier, but had also increased slightly in February, with a small uptick in approvals broadly based across types of borrowers. And they said a lower level of interest rates could still be expected to support the economy through a depreciation of the exchange rate and via reducing required interest rates payments on borrowing, freeing up cash for other expenditure. Now, that would be the Reserve Bank's rationale for a rate cut. And they said members also discussed the scenario where inflation did not move any higher and unemployment trended up, noting that a decrease in the cash rate would likely be appropriate in these circumstances. So that would absolutely drive a rate cut. And they said members agreed that there was not a strong case for a near-term adjustment in monetary policy. So I conclude from that probably no rate cut soon, but perhaps later in the year. Now, in the context of what the Reserve Bank said, UBS made the point that they think the CPI will be lower ahead. And in fact, that will put more pressure on the Reserve Bank to cut interest rates in the weeks and months ahead. And they also highlighted the fact that the sentiment index for the Reserve Bank is still in negative territory. So in a way, all of the indicators that they look at suggests rate cuts sooner rather than later. And we have to contrast that, of course, with what the Reserve Bank said themselves with regard to the indicators that they'd be looking for in terms of making rate cuts ahead. So turning to the latest house price growth statistics, CoreLogic reported that in Sydney, it had fallen 0.1% over the last week, down 0.38% over the month so far, down 2.71% over the quarter, down 10.9% annually, and from peak 14.3%. In Melbourne, there was a very slight rise, 0.02% over the last week, but down 0.39% over the month so far, down 2.85% over the quarter, down 9.9% over the last year, and down 10.7% from its peak. In Brisbane, it was down 0.07% over the last week, down 0.28% over the last month, over the quarter down 1.02%, annually down 1.9%, and from peak down 1.5%. In Adelaide over the last week, prices fell by 0.15%, over the month to date 0.22%, over the last quarter 0.46%, annually 0.3% higher, and down from the last peak 0.8%. In Perth, prices were down 0.07% over the last week, down 0.21% over the last month, over the quarter down 2.35%, annually down 8%, and from the last peak 18.3%. And across the major 5 cities, the weekly fall was 0.07%, the month so far 0.35%, over the quarter down 2.42%, annually down 8.7%, and from peak 10.1%. So the latest data could be interpreted as suggesting the rate of fall in home prices is easing slightly. But frankly, the change in momentum is so small that we'll have to wait and see how this plays out ahead. And just one little snippet of information relates to Box Hill in New South Wales. Because there, according to the latest data from CoreLogic, the median values now are 59.5% lower than a year ago. Now, there are some unique conditions in Box Hill, and that includes a lot of subdivisions. But nevertheless, this quantum of fall underscores again the risk relating to negative equity. And this is something that we discussed this week on 7:30. And you can watch the show and also my commentary on the show and the discussion around it, which highlights, I think, the important context for changes in negative equity and the implications of it going forward. Now, turning to the latest auction clearance rates, the latest data from CoreLogic showed a very slight uptick this last week, although still on very, very low volumes. And overall, the weighted average was 52.2%, with Sydney sitting at a higher 55.8% and Melbourne at 51.6%, Canberra at 51.4%. But these volumes are still considerably down on a year ago, and there is very little here, I think, to suggest a change in the market conditions. This despite many property brokers now talking about a price recovery and that auction clearances are going to bounce higher. I'm just not convinced by that. I think we're going to have to watch the data over the next few weeks. What I can say is that the credit impulse is still easing, and as a result of that, I firmly believe that home prices are going to slide further. Earlier this week, the Grattan Institute pointed out that the Coalition's budget assumptions that expenditure would fall from 24.9% of GDP in 2018-19 to 23.6% during the next decade amounts to cutting spending by more than $40 billion a year in 2029-30. And this raised the natural question of exactly where those cuts will come from. According to the government, it's from things such as lower welfare payments and lower interest payments on government debt. But the Grattan Institute's Danielle Wood described these assumptions as heroic, and I tend to agree. NAB said that an additional charge of $525 million after tax or $749 million before tax relating to its customer remediation program would be taken this time. As a result, the 1H19 cash earnings will drop by around $325 million and earnings from discounted operations by $200 million. Now, we discussed this in our post, Customer Remediation Costs Explode, because this is yet more examples of the banking sector taking huge costs and having to deal with those costs in some way, either by cutting returns to shareholders or, indeed, lifting their fees and charges in some way. Now, the ABS has reported that Australia's trend estimate of employment increased by 20,700 persons in March, with the number of unemployed persons increasing by 3,000 people, the unemployment rate remaining steady at 5%, the underemployment rate remaining steady at 8.2%, the underutilisation rate remaining steady at 13.2%, the participation rate remaining steady at 65.6%, and the employment to population ratio remaining steady at 62.4%. Increases in trend employment were observed in all states and territories except Western Australia, down 200 persons, and Tasmania, down 100 persons. And the largest increases were in Victoria, up 7,600 persons, followed by New South Wales, up by 6,800 persons, and Queensland, up by 4,900 persons. And the seasonally adjusted unemployment rate increased by 0.1 points to 5% in March 2019, and the participation rate increased by 0.1 points to 65.7%. So, in a way, there could be some early warning signs here of unemployment beginning to turn upwards. And if that was the case, then that would put more pressure on the Reserve Bank to cut its interest rates. Now, China reported that their GDP number was 6.4%, which was a little stronger than many analysts expected. And they reported that consumer activity and property-related activity both rose. Now, of course, there's been a considerable stimulation going on in the Chinese economy to try and support growth. And that may be some good news with regard to Australia, because if that stimulation leads to greater demand for steel, then our exports could continue and potentially grow. However, a lot of the stimulation appears to be consumer-related rather than construction-related. So I'm not personally sure that there is going to be a massive uptick in demand for steel. Now, the local markets were closed on Friday, but the ASX 100 ended up 0.07% on Thursday to 5,157 and is approaching the rarefied ranges last visited in August 2018. And US stocks were higher after the close on Friday, as gains in the industrials, telecoms and technology sectors led shares higher. At the close in New York, the Dow Jones Industrial Average gained 0.42% to hit a new 6-month high, while the S&P 500 index climbed 0.16% and the Nasdaq Composite Index gained 0.02%. Rising stocks outnumbered declining ones on the New York Exchange by 138 to 127, and 17 ended unchanged. And the volatility index, which measures the implied volatility of the S&P 500 options, was unchanged to 12.09. Gold futures for June delivery was down 0.01% to 1,277, and elsewhere in commodities trading, crude oil for delivery in May rose 0.38% to $64 a barrel. The euro-US dollar was up 0.15% to 1.1245, while the US dollar Japanese yen fell 0.04 to 111.92. And the US dollar index futures was up 0.49% to 97.13. Now, next week will go a long way in determining whether investors should be concerned about the dawning of an earnings recession, or whether back-to-back quarters of negative growth can be avoided in what is the heaviest week for profit reporting by US companies. A wide swathe of S&P 500 sectors are scheduled to report next week, with 155 companies representing over $9 trillion in market capitalization in the queue, more than 35% of the total for the index. Rapidly sliding expectations for second quarter profit growth have sparked concerns about an earnings recession. Right now, estimates are for growth of 2.1% in the second quarter, down from 6.5% increase at the start of the year and 9.2% back in October. And in a recent note to clients, Morgan Stanley said that while companies are likely to beat the significantly lower bar for the first quarter, they believe it won't be the trough for the year, noting that with the S&P 500 now near the top of their valuation range, with a forward price-to-earnings ratio of 16.8, there is not much upside remaining, without a resurgence in growth that the market currently anticipates. But I think at the moment we have to conclude that the stock markets around the world are extremely buoyant, basically thanks to the fact that QE is in the wings and company profits are still looking quite reasonable. But the broader overhang from economic slowdowns look to me to have more of a negative impact than perhaps the markets are wanting to recognise at the moment, and it's quite likely that this will flow into lower home prices and lower economic momentum as we go into the next few months. But time, as they say, will tell. Now, just before we close, let me tell you that I'll be releasing a special show shortly where I go into some detail on the whole question of home price indices. It's a question I get asked a lot, and I want to demonstrate how complex and how confusing the information in the public domain actually is. In fact, you can pretty much make a case for whatever home price fall you like, or home price rise you like, depending on which data you decide to go for. So watch out for that post, which will be released in a couple of days. If you found this post useful, please like it, share it, add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive alerts on our future posts. I'm Martin North from Digital Finance Analytics, wishing you all a happy Easter, and I'll see you next time.